This accounting mini lecture covers inventory costing using the FIFO method. Okay. In this case, we're going to be using inventory costing, assuming a perpetual inventory system, which, as we've discussed earlier, almost all companies use the perpetual method of accounting for their inventory. This just means that we continually track and update our inventory purchases and sales as they occur. Now, it's important to remember that with sales transactions, it is going to impact both the income statement and the balance sheet. So that's why it's very important for us to match the cost of sales against the sales that were generated from the sale of that merchandise. Okay. Now, we're going to be learning about multiple cost flow assumptions. Now, what I would really like to emphasize is keep in mind that regardless of the costing approach that a company uses for their inventories, they can still sell the merchandise with a physical inventory flow that is different from the cost flow. Let me explain what I mean by this. For example, if a company were using LIFO, which is last in, first out from an inventory costing perspective, they would still likely want to sell their oldest inventory first because that's what makes sense. But they could still use the LIFO approach for inventory costing. With inventory costing, we are only tracking cost flow. We are not worried about the physical flow of the inventory. Inventory costing is only focused on the flow of the cost to the income statement. Okay, so in this little chart here, we can see the percentages of companies that use each method. You can see FIFO is by far the most commonly used method. We've got 27% using the LIFO method, about 20% using weighted average, and about 3% of folks are using something else, maybe specific identification. But you can see that FIFO is the most commonly used approach. So that's actually what we're going to be focusing on in this particular video. All right, FIFO assumes first in, first out. So from a cost flow perspective, the first costs that come in the door are the first costs that we are going to allocate to cost of goods sold. So let's look at an example. This is the information that we're going to use for this particular example. We're going to see that this company began with a beginning inventory. They had 10 units at a cost of $91. They then make some additional purchases. They then have a sales transaction. They have 2 additional purchase transactions, and finally another sales transaction on August 31st. Now, the next couple of slides, we're going to look at how to account for the cost for all of those transactions. Okay. Again, with FIFO, the oldest costs are going into cost of goods sold first. Our more recent purchases is what we're going to leave in ending inventory from a cost flow perspective. Okay. So let's look at the first sales transaction. The first sales transaction, if you'll recall from the previous slide, we sold 20 units. Okay. Well, let's look at what we have available for sale. We have 10 units from the beginning inventory balance, and we have the 15 units that were purchased most recently. Assuming FIFO, the first thing that we want to do is sell those 10 old units that were in the first bucket of inventory. We can then dip into this second purchase and sell 10 of those at the $106. Okay. Now, let's look at our next sale that occurs on August 31st. Again, we want to sell the oldest inventory first. So if we need to sell a total of 23 units, the first thing we're going to do is grab the 5 old units that are sitting here at $106. We can then dip into the second bucket that was at $115, and that's what we're going to assume was sold. And under the FIFO assumption, you can see that our total cost of goods sold comes to $4,570. Total inventory is at $1,420. You can see how those costs flow to the income statement as well as the inventory account on the balance sheet. And that's how we apply the FIFO method of inventory costing. Thank you for taking the time to watch this video.